Many people are now hoping we will achieve a soft landing, with interest rate cuts already underway and the Fed saying the economy is doing just fine. But despite the latest CPI and jobs report data looking fine on the surface, if we dig a bit deeper into the details, we can start to see some very worrying trends emerging that are somewhat masking the truth of what is actually going on in the economy right now. However, it could now already be too late to avoid repeating mistakes made during previous major recessions, and we could now be facing one head on. First of all, CPI and core CPI have both come in hotter than expected, right after the Fed decided to cut interest rates aggressively by 50 basis points, raising more concerns about a second wave of inflation hitting the economy. CPI has fallen to 2.4%, but comes in above the 2.3% that was expected, while on a month-on-month basis, it has come in at 0.2%, above the 0.1% expected. Meanwhile, core CPI, which does not take into account food and energy, has risen to 3.3%, which was above the 3.2% expectation, while on a month-on-month basis was 0.3%, above the 0.2% expected. Now, these hot CPI numbers, particularly in core CPI, does show the progress on getting inflation back under 2% looks to have stalled, and it now has interest rate cuts fighting against it in the opposite direction. And with all of the trouble that is going on in the Middle East right now, causing oil prices to continue to surge, this seems like a very dangerous time to reignite inflation when the cost of core goods is set to potentially shoot up in the coming months. History tells us that cutting interest rates too quickly after inflation starts to drop from an initial peak can lead to a second wave of surging inflation, just like in the 1970s when this inflation resurgence reached even higher highs. And the path that we are now treading today is eerily similar to the one that we saw in the 1970s, both in terms of Fed decision making as well as how closely the CPI data is mirrored when both time periods are charted on top of each other. Now, the latest jobs report on the surface looked quite strong and signalled the economy was in good health, with 254k new jobs being added in September, smashing the 150k consensus, while the unemployment rate also ticked down to 4.1% from 4.2%. However, looking closer at the data behind these metrics, as well as some of the trends that are now emerging in the labour market, we can see that things are not as rosy as the media and government is making it out to be. Now, for starters, the government themselves are responsible for a good portion of these new jobs that are being created and have been for some time now in what is a continuing trend. The number of government jobs tracked by the Household Survey soared by 785k in September, from 21.421 million to 22.216 million, which is the biggest monthly surge in government workers on record if we exclude the pandemic blip. Meanwhile, the number of private workers by comparison rose by just 133k. And the Establishment Survey, which uses non-seasonally adjusted numbers, also tracked the exact same pattern, showing government jobs surged by 918k, while private sector workers actually plunged by 458k. Now, taking both of these survey numbers, which take into account seasonally adjusted and non-seasonally adjusted numbers, we can see a big gap now in the number of new government jobs that have been added in September compared to private sector jobs. And as this report from Zero Hedge shows, without these 785k government jobs being added in September, the unemployment rate would have risen to 4.5% rather than what actually happened, where it declined to 4.1%. Looking at the year-on-year growth we have been seeing in government employees, we can see that this growth has bloated to now being at 2.3% and was even surpassing 3% growth at the end of 2023. Now, this is far higher than the typical annual government employee growth that we were seeing pre-pandemic in the 2010s, where it was typically under 1% and sometimes even negative. It's clear, therefore, that the government is ramping up the number of new hires that they are making, and the growth in the number of new government jobs is much higher now compared to just 5 or so years ago. And what makes things even more interesting is when we look at the same metric of year-on-year employee growth, but for the private sector. As you can see here, annual growth in the number of private sector employees is right back down to the pre-pandemic norm in the mid 1% region, sitting at 1.4% as of September. And looking at the number of Indeed job postings also does back this up, and it has been downtrending since 2022, now almost back down to the pre-pandemic normal levels. So what this tells us is that in today's economy, government employment is growing at almost double the pace that private sector employment is, which is vastly different to pre-pandemic, where the opposite would typically be the case. This begs the question, what condition would the labour market and economy in general be in if the government was hiring new employees at a similar pace to that of pre-pandemic? This rapid government employment growth doesn't come with no cost though, as we are continuing to see government debt surge at an astronomical pace. And the most recent explosion in debt that we have just seen is outright scary, where around $500 billion has been added in just the last 3 weeks. And this spike continues the debt spiral trend that we are seeing, where new government debt is being added at a faster pace than we have ever seen before, and the situation is starting to look more and more out of control by the month. The government is now spending an eye-watering $1.1 trillion every year on interest payments on this debt pile, a figure that has skyrocketed in recent years and was just half of this in 2019. Meanwhile, the US budget deficit has risen, continuing to tick upwards on average, meaning that the stream of new debt getting rapidly added to the already massive debt pile won't be ending anytime soon. The government simply can't keep spending like this forever, and eventually there will need to be cutbacks on the spending, which raises the question on what impact this could have on the job market and the broader economy if the number of government jobs actually starts to get cut further into the future. On top of this, we are also seeing an increase in the number of part-time workers, while simultaneously the number of full-time workers is stagnating and even starting to decrease, which is a sign of weakness in the economy. This is because there are more people being pushed out of full-time employment, which generally has better pay and better employee benefits, and instead are being forced into part-time work, which generally has worse pay and worse employee benefits. And we're also now seeing the number of people being forced to hold multiple jobs as a percentage of those employed is starting to rapidly rise. And this is generally another sign of weakness, because it means that more and more people are being forced to work more than one job just to survive and put food on the table. And perhaps more concerningly is the rise in the number of these multiple job holders that have a full-time job as their primary job, but have had to pick up a secondary part-time job as well in order to supplement their income. This number has been surging at a rapid pace for the last few years, and is a clear sign that the number of people struggling financially is rising quickly, as almost nobody who has a full-time job would take on a secondary part-time job if they didn't need to in order to get by and pay the bills. What we are seeing in the consumer credit market recently also does show just how much the average US consumer is struggling right now, as we can see that credit card debt continues to hit new all-time highs quarter after quarter and is now sitting at $1.14 trillion. But not only is this consumer credit card debt pile rising, but the interest rate on this debt is rising too, and it is now at astronomically high levels compared to at any point in history. Now, the average interest rate on credit card plans is now at 21.76%, which not only is a new all-time high, but it does also dwarf the usual rate of around 14 to 16% that we have seen pretty much since the 1990s. This means that consumers are not only taking on more credit card debt, but they are also being crippled with even higher interest payments, making it impossibly hard to get out of this debt hole for many. And this is evident in the surge that we are seeing in the number of delinquencies on credit card loans, which has blasted through the pre-pandemic high of 2.66% and is now at 3.25% and showing no signs of slowing down anytime soon. With the personal savings rate still languishing near all-time lows, it is clear that a number of US consumers don't have enough savings to get by, which is leading to an increase in the number of people resorting to credit card debt, some of whom can never pay the debt back. Now, there are clear signs that the Fed is aware that there could be a whole load of problems hitting the economy soon, and are now starting to panic about their rate cut decisions, concerned about the numerous inflationary forces that could be hitting the economy soon. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, please do leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.